please welcome to the stage Jeffrey Bohn.
Thanks very much. Thanks to Carl and Frank for inviting me here. I'm not an energy person per se. My background is quantitative finance. So I'm affiliated with a research institute at UC Berkeley called the Consortium for Data Analytics and Risk. And I'm also part of a startup. But I spent many years in financial institutions managing R&D groups. So I'm one of these people that move between academia and industry, trying to figure out how to make things work. And so I'm going to talk today about some trends that I think are relevant to any kind of new technology, particularly ones that are going to assist in improving the quality of the planet, dealing with big issues like climate change, et cetera. And I want to start with this quote from Galileo, which I quite like, which is measure what is measurable and make measurable what is not so. Because I think one of the things that's happened in the last 20 years is we now have a lot more data. In fact, we're awash in data. We have sensors. We have new kinds of ways of actually authenticating data, say with distributed ledgers. This is all creating new opportunities in an emerging space that's often called ESG. Now, I've been doing research in this particular space for enough years that we used to call this socially responsible investing. So we used to call it SRI. Then it was called corporate social reporting. And then I think an investment banker coined these terms, environment, social, governance. So you'll often hear ESG as being this new investment trend. Now, unfortunately, that sets the stage for a marketing spin. That was not the intention for ESG. The intention was to bring in a set of criteria with respect to evaluating investments that go beyond just the financials in the short term. Most people would argue that these issues hit the firms in the longer term. And most large funds, so Peter was talking about all this capital on the sidelines. There's actually a lot of capital sitting particularly in sovereign wealth funds, national pension funds, life insurance companies that are strategically allocated to ESG investing. And I'm going to add another component, which I call resilience, which I'll talk about a little bit more later, because I think this is a piece that's missed in a lot of the ESG discussion. But the point is, this capital can't find enough investments. And so one of the things that I and a few others are trying to do is we're trying to come to these communities where there's lots of very interesting things happening and figure out if there's a way we can bring together the capital and these new opportunities so that we can take advantage of some of these things. So I'm going to talk about some of the trends in this space, some deals that have been actually successfully put together, although they're very small, and give you an idea of where this trend is going. Now, a lot of this is, if you notice my title, it's all about risk transfer. And risk transfer is really the question here. And there's some very interesting shifts in the insurance and investment community that impact this type of social impact investing, or sometimes it's called even sustainability investing. The first is there's a shift from just looking at these risks and trying to understand and cover them to actually using some new tools and data to predict and prevent. Okay, so that actually opens the door for certain types of insurance and bond products, which I'm going to talk about later, that weren't really in the zeitgeist of insurance before and some of the investment community. The other thing is there's a shift from trying to insure or fund just specific individuals or entities, although that will continue, to think in terms of outcomes. Now, we see this more prominently in things like new auto insurance policies where you are insuring the ability to get from A to B, or the ability to ensure that actual things are accomplished per a set of criteria, as opposed to just generically saying I'm going to insure business interruption, or I'm going to fund a project that's just going to improve resilience or address climate change. And this has set the stage for a lot of new companies, including a couple that I'm involved in, where we're trying to create these new resilience as a service opportunities. And I think this is also relevant in the energy space. Now, one of the key drivers here is the fact that we have this new oil. And that is all this raw data that's being generated in sensors and satellite feeds and things that are on the internet being collected by governments and investment professionals. But there's not enough people focused on curating this data. So this is really a key constraint. And it means that the data ends up becoming more important than the models. So as people develop new technologies, as they expand existing technologies, it's the owners of that data that are going to be the most important players going forward. And it's an important insight. I mean, I have a PhD in quantitative finance. I've built models my whole career. But it turns out models are not nearly as important as the people who own the data. And this is an issue that can be resolved with things like distributed ledgers, or what's sometimes called blockchain. Because if I can tell you where the data originated, and I can track back and authenticate that, I can open up new opportunities. So I'll give you an example. Reducing carbon emissions is a big issue in the ESG space. What if I put a sensor on every carbon-emitting vehicle, piece of equipment in a company, and I instantiated into a blockchain every time it emitted carbon? Now I'd have a way to definitively and objectively validate how much carbon is being generated by that company, and I wouldn't get into these arguments that are currently happening right now with respect to whether certain companies are meeting their carbon, their net zero targets. So that's just an example of some of the things that are developing, and it's a very interesting opportunity and creates the opportunity to create lots of parametric instruments, either vis-a-vis insurance or vis-a-vis very specifically designed fixed income securities. Now, the other thing that's part of this whole discussion is how do we really measure or manage and model sustainability? And one of the big projects I'm involved in right now is trying to build what we call a digital twin of all the underlying networks that support our life. And we think, that those of us who are involved in this project think that this is really a step toward understanding better and quantifying the economic value of some of these new energy approaches and the new ways of reducing carbon emission. And if you can do this at a very granular level, it's much easier to convince partners, such as governments or even nonprofits, to put money up, because you have very specific outcomes that you can focus on. And these digital twins allow us to look at what we call dependency risk. So this is the risk that you are building, or your government, or your society, or your company is going to have a problem as a function of disruption to outlying networks, such as power, water, transportation. Now, one of the big problems in the commercial property insurance industry is many companies buy what is called business interruption insurance. And this is supposed to pay out when there's something that affects the business. Now, what's often the case, though, is what affects the business doesn't necessarily ruin the property. And most of these policies are written in such a way that if the business property is not damaged, so let's say you have an earthquake, and I'll give you a real example, the 2011 earthquake in Japan. You had an earthquake that happened off the coast of Tohoku. It actually impaired several bridges in Tokyo, which were 150 miles southwest of the epicenter of that earthquake. Many distribution warehouses could not function for several weeks. Their business interruption insurance did not pay. The reason? The buildings weren't damaged. So this is an example of what we call dependency risk. And energy is a big piece of that. I was just looking at the data recently for power outages in the United States, and the top 5 states that experience power outages are California, New York, Ohio, Michigan. Can't remember the last one. But what's extraordinary about that is we're talking hundreds of times a year, power going out in such a way that it disrupts business. And this is a dependency risk that's not well quantified, but with these digital twins, we can start to understand that and potentially address this with better designed securities, which I'll talk about. Now, what's this digital twin? So this is something, I'm involved in a startup called One Concern, and we've created a digital twin that gets delivered over this service called Domino. But today, and I just want to give you an idea of what's possible today, we can now model all the substations in the United States, about 45,000. Now that requires us to collect a lot of fragmented data, curate it, and then use some machine learning to fill in the gaps. And I don't have time to go through the details, but that's a function of compute power and machine learning development that's only been available in the last few years. We model just under 3 million highway segments, so we can understand the impact at the highway segment level. 600,000 bridges. And we can look now at 160 million properties at the property level. That's really the innovation here that's quite interesting. And understand what's that dependency risk. So this allows us to then go back and look at the catastrophe risks that we're potentially exposed to. And one of the big drivers is the fact that climate change is changing the risk profile. You know, often people will say to me, do I really need to worry about this? The risk is so unlikely that I'm not sure that I need to be investing. The truth is climate change is changing that outcome. In Japan, the last 3 years, not including last year, but the last 3 years before, constituted 1 in 200-year events per the existing actuarial models used by insurers. So that suggests that climate change, and if you don't believe in climate change, something is changing that underlying data generating process. And this type of digital twin allows us to understand what's going on. Now, what kind of analysis can we do? Well, we can look at 2 buildings that are close to each other. And today, without this kind of technology, we would generally assess the risk the same. But if we now look at the network within which they operate, we can then distinguish what is the risk as a function of, say, the power dependency. So in this particular case, it turns out that even though building 1 is close to the waterfront, building 2 has a problem in the substation it relies on is closer to a fault line and to potential flooding. And this gives you the ability then to differentiate in a way that we couldn't really do before and assess resilience quantitatively. And so this is why I'm saying this needs to be added to the ESG discussion, because ESG often talks about things like environmental, the bad things. So am I polluting the environment? Am I emitting carbon? Or if we move out of the E into social, do I have a non-diverse labor force? This allows me to add another component and ask the question, am I really prepared for these tail risks that are now becoming more likely and are more severe, and understand them contextually? And this just gives you an idea of all the lifeline networks that we rely on. And one of the things that I was thinking about as I was putting this together, all of this relates back to energy. So energy is a big component of this everywhere. Now, what can we do in terms of the financial instrument innovation? And this is what I think is quite exciting these days. Because these types of the data, the technology is giving us an opportunity to redesign some of the tools that are used to transfer risk. So here's an example of a resilience bond. And in fact, there's an example, an actual deal. It was very small. It was put together with respect to improving the forest management in California to reduce the risk of wildfire. Now, the thing that's interesting about this is you identify a resilience project. You have to have some kind of a sponsor that can do the technical work. In the case of this bond that I'm familiar with, there was a nonprofit that had the scientific capability to understand what needed to be done to clear the ground brush and reduce the wildfire risk. Then you have the issuer, so you have some entity. That might be a company, it might be a government, and you have the investment community. And if I just do all 3 of those without that public partner, most of these deals cannot be done. I've been involved personally in a few deals like this, and what generally happens is we do the technical work, we have the issuer that wants to issue the bond, and then the investor is interested because they have this allocation, strategic allocation to ESG or social impact investing. But the bid-offer spread, that's a finance term, but this difference between what the investor wants and what the issuer is willing to pay is too large. And what you need is a public partner typically to plug that gap to start. Then what happens is you kickstart the market, And over time, you can then see more and more people willing to do those kinds of issuances, and the need for the public partner goes away. So this is something that is very interesting, and it is a consequence of having much better understanding of what we're measuring and the ability to track outcomes. I think that's something that's quite important. So if I can identify focused, narrow, measurable, and monitorable criteria, I can actually build very interesting solutions that avoid what's commonly the case today, and that's what I call metric confusion. One of the problems in the ESG space is too many firms have tried to come up with their own approach to measuring the ESG output, whereas if we can go back to the people issuing the securities and be very specific about what they're doing, like how am I fixing the wildfire risk, or I've been involved in a deal associated with coral reef protections, coral reef restoration. Those are the types of things where we can now change the incentives and potentially fund more projects. So the key thing here is the ability to measure and monitor. And I have to do that objectively. I don't want to rely on the people who are doing the issuance to actually do the monitoring and the reporting. The second thing is we want to use a portfolio approach. And there's actually, in the finance community, there's something called a covered bond, which I think is actually a great structure for this type of thing. So for a covered bond, what happens is you might have many projects. And those projects all have cash flow associated with them. But the bond is structured so that the lender or the creditor has the ability to go back to either the underlying cash flow of the projects or to the bank that underwrites the deal. And this, again, is an opportunity to kickstart some of these new approaches. If we do that portfolio approach, then we get something that looks a little more in the way that it looks as this X-Prize approach, where I just fund lots of projects, and I don't get so hung up on any specific one. So that's the portfolio approach, allows me to raise the bar in terms of the things that I raise the ability to offer more financing to new projects. The other thing that I can do is I can often de-risk projects with something called parametric insurance. So this is where we have an indicator that we can track, and then the indicator generates an automatic payment in case as opposed to having the complicated claims process, which is typical for insurance. So a good example of parametric insurance that works quite well, not necessarily in the US, but in other countries, is flight delay. So this is where you buy insurance and it pays out some kind of a claim if your flight is delayed by some pre-specified amount of time. But we can imagine parametric insurance in many of these other spaces that allow us to now de-risk projects that might otherwise be very difficult to fund. So you could imagine parametric insurance working together with some of these new resilience bonds or even climate bond initiatives. That's something that we're starting to see discussions about. We don't see any deals yet, but that's something that is developing. And in the end, you're really trying to trade off what I call the tetralemma. And it's interesting. Somebody once asked me, why do you call it a tetralemma and not a quadrilemma? And it has to do with the fact that tetra is from the Greek, and the Greeks were much more optimistic than the Romans, because quadrilemma is from Latin. And typically, quadrilemma means I'm trying to deal with 4 undesirable choices. Whereas this one, I'm just trying to trade off these things. So when I design these securities, I have to find things where the indicators are correlated with underlying risk, whether it's a bond or an insurance product. But the more comprehensive I'm going to make it, the less correlated it will tend to be. It also needs to be objectively measured, and in the end, it needs to be profitable. And one of the problems in this space is I often can't get all 4 of these things at the same time. So what I'm trying to do is I'm trying to do my best, given the information I have. And one of the things that you should leave this presentation with is understanding that we now have a much better opportunity to offer at least correlated, comprehensive, and objective instruments, whether they be resilience bonds or parametric insurance. They're not always profitable, But I think that this is leading us down this path where we're going to see much more capital available in this context. And so I'll just leave you with this final point, that we have lots of material risks that need to be transferred, whether they be dependency risk or how we're dealing with energy. We need to make them measurable. They need to be correlated with that underlying risk and authenticatable. If I can do all four of these things, then I think we can unlock a lot of capital that takes us much further along to funding some of these projects we're talking about. Thank you. I don't know if we wanted to do any Q&A.
John Brandenburg, Kepler Aerospace. And on the parametric insurance, we're doing energy research to replace fossil fuels eventually, right in the middle of Midland, Texas, the headquarters for fossil fuels. I don't want to put my neighbors out of work. I love them. But what is a middle course, do you think, on reducing carbon emissions without disrupting the fossil fuel industry too egregiously, which is a major part of our economy?
Yeah, no, it's a very good point. I mean, there's this big debate in the ESG space about whether you should go for full divestment or should you invest in these carbon-emitting firms and just help them slowly transition away from primarily relying on fossil fuel. And I think that some of these tools can facilitate the latter, which can kind of solve some of that employment problem. But frankly, we have to figure out what the new energy opportunities are and shift those resources slowly over to that point. I think that's probably the only way to accomplish that. Because otherwise, you know, I don't think we can turn on a dime and say, okay, we're just going to completely shut down these businesses. That's not feasible. But at the same time, if we do nothing, we're going to have trouble.
Just one follow-up question. Since natural gas gets most of its energy from hydrogen rather than the carbon, and of course methane is a greenhouse gas itself, so you have to flare it off rather than letting it. That's what we see at Midland a lot now, is they're flaring off all this natural gas because they can't run pipelines to the wellheads fast enough. But would you say that a legitimate solution, at least for the United States, is to try and accelerate this shift to natural gas, and in the interim, nuclear power? We can buy the reactors from the French. Do you think that is a reasonable interim solution?
Yeah, I think that's one solution. I mean, I think this could be a very contentious debate. But I do think that it's, at least from my perspective, we need to be funding a lot more of this kind of nuclear-related research, whether it be the LNR or small molten salt reactors. And some of these tools can de-risk that. I don't know how to solve the political problem in countries like the US and Germany, where we seem to have just gone off the rails in those discussions. But these tools can, in fact, provide risk transfer mechanisms that can figure that out. But we also need to have much more investment from the government. I mean, look at how much was invested on the pandemic to accelerate the vaccine development. I mean, I would think that, you know, if I don't know if this is going to happen, but if they declare, if the U.S. government declares climate change an emergency, well then, why don't we just put together, you know, Operation Warp Speed 2 and set aside, I don't know, $100 billion for nuclear research? You know, that to me, I think is really the solution. I don't quite understand. I mean, I lived outside the U.S. for most of my adult life, so I don't understand politics in the U.S. Anymore. Okay. Anyway, no.
So it was great hearing folks are from Midland, Texas. I'm from Bakersfield, California, the oil capital of California. And my question, we're doing a public-private partnership there with the university and the city of Bakersfield, and the state is leading the way. My question is, what role can public-private partnerships play in not just the data side on the validations, but economically, the economic impact that is done in local communities like Bakersfield as a justification for the public-private partnerships, in addition to all the additional ESG measurements? Do you see that as an opportunity, or are there routes towards integrating that into the considerations?
Yeah, and I think I'm out of time, but I'll just quickly answer that question. That is a huge opportunity. In fact, one of the things that is possible with these capabilities is the opportunity to tie things like government grants and subsidies to direct, observable, and measurable outcomes. So as opposed to just saying, I'm going to give you a grant to solve this wildfire problem, and this is a real example, I'm going to give you a grant conditional that your proceeds from this resilience bond issue actually solves this problem subject to these measurable criteria. So that's the point. If I can measure and monitor and authenticate the outcomes, then it's much easier politically to go back and say, let's tie the grants and the subsidies back to those capabilities, or to go to NGOs as well and have them do the same thing. And I think that's really the opportunity, is that measurability, because then you have a lot more cover politically after you've given the money.
I agree.
Okay, I don't know if, I think I'm out of time, but.
Thank you, Jeffrey. Yeah, you are. Thank you so much.